Good day. My name is Xu Congmei, and my student number is P162545. Today, we share research on boom Armada and hibiscus petrolol with the KLC index as the benchmark. Our study covers 50 monthly data points from February 2018 to March 2022, sourced from company reports and Bursa, Malaysia. Our research has 7 sections. Today, I will share the first 2, company and index overview and independent risk analysis. Boom Armada is a leading offshore oil and gas service provider with core businesses in FPSO operations, offshore engineering, and maritime logistics. It serves global gains, but is highly dependent on large projects, facing oil price and competition risk. Hibiscus petrolol focuses on major oil field development with diversified access across Malaysia, the UK North Sea, and Australia. This strategy ensures stable cash flow and strong anti-cyclical resilience. The KLC index, Malaysia's core benchmark, has low volatility, 3.0474% monthly STD div, and reflects systematic risks with an average monthly return of 0.2553% during the study period. Independent risk analysis. We evaluate 3 key indicators. Average return. Hibiscus is 1.917% monthly return outperformance. Boom Armada's 1.214%. And the KLCI's negative return, showing strong anti-cyclical ability. Volatility. Boom Armada's 19.5282% STD div makes a monthly drop 60.49% is much higher than hibiscus 15.9434%. Risk-adjusted efficiency. Hibiscus CV 8.317 is only 51.7% of Boom Armada's 16.086 with better risk return matching. Hibiscus outperforms Boom Armada in returns, stability, and risk efficiency. The KLCI is a reliable hedging benchmark. That's my sharing. Thank you.
My name is Xu Hengkai. Based on the previous Tom Person, we are explores the different exist. First, hibiscus. First realm, preference where even during weak market conditions, while the KLCI shows negative returns. Hibiscus still deliver positive monthly gains. Thus, reflects its for quality, capacity, and stable operations. In contrast, Boom Armada shows high volatility. Its business depends on large offshore projects. Thus, projects are long-term and capital intensive, which leads to unstable cash flow and high risks. Next, I will talk about how returns change month by month. On the left, chart we see monthly rate movements. To me, Amanda has lots ups and downs. Hibiscus shows smoother and the ball movements. On the right side, the distribution chart supports this. Common Amanda has extreme values is the sharing. That's lots. Hibiscus Western amounts constantly is in the middle variance. This means hibiscus has better downside risks. 洪水外面 up Amanda is more aggressive and volatility. 真为 combining the stocks into a performance of this portfolio use coin or at each one at for 15%. The covariance between the two stocks is positive, but not perfect criterion. As a result reverse coefficient x works. The portfolio standing deviation is lower than both in the visual stocks. This confirms that betting SS can reduce as the T-negative risk even within the same industries. Now we move from coin weight to the minimal variance portfolio. The goal here is to minimize risk based on the calculation. The optimal allocation is absolute 0.% between Amanda and percent hibiscus petroleum. Hibiscus has a higher weight because of its lower volatility. Means Amanda still contribute to diversification, but its weight is reduced to control overall risk. Thus, allocation produces the lowest portfolio volatility. Finally, we present the efficient frontier. This curve shows the trade-off between risks and right the leftmost point represents the variance portfolio. It has the lowest risk. Moving along the curve means accepting higher risk in exchange for higher return. Conservative investor shoots near the MVP. Aggressive investor may choose portfolio with higher exposure to me Amada. This graph helps in which the make this sense based on their risk preference.
Hello everyone, my name is Gong Sijun. The beta coefficient measures how sensitive a stock is to overall market movements. In this analysis, we use the KLCI as the market policy and calculate monthly stock return based on monthly closing price. According to results, Bumi Ahmad's beta is 1.89, while high case Portugal's beta is 1.76. Since both betas are more than 1, these stocks are more volatile than the overall market. Bumi Ahmad has a higher beta, which means its share price is more sensitive to market change due to involvement in oil and gas wise, which are affected by global industry price and market. In comparison, high case Petroleum has a slightly lower beta, but it is still relatively higher as an oil and gas exploration and production country. Its performance is also linked to crude oil price and overall economic conditions. The results show that both stocks clear rather high systematic risk and are more suitable for investors with a higher risk tolerance. Next, we examine the secondary market layer (SML), show the relationship between expected return and systematic risk, measured by beta, based on the capital asset pricing model CIPM. Here, we apply risk-free rate of 3.59% and a market return of 9.19%. Using CIPM formula, we calculate the expected returns for both stocks. We plot beta on the horizontal X and the expected return on the vertical X to constitute the circular market layer, as shown in Figure 6.1. Both Bumi Ahmad and high case purchase are positioned to the right of the market portfolio, show higher levels of systematic risk. Bumi Ahmad is positioned slightly higher on the SML than high case purchase, which is consistent with its higher beta and higher expected return. The SML analysis further supports the findings from the beta analysis. If a stock's actual return is above the return predicted by the SML, the stock may be undervalued. If it is below the SML, the stock may be overvalued. Thank you.
Hi everyone, good day. This is Felix Moon. Alright, let's start with this slide. EPS grew from 2020 to 2022. Look at this graph. On one slide, we have company HP. Steady upward trend. From RM.145 in 2020 to RM.226 in 2022. That is a 24% annual growth rate, consistent, reliable. And what drives that? Rising oil prices, better production, smarter cost control. This isn't lucky, it's performance. The company has stable cash flow, strong operational discipline, and is delivering results year after year. Now, contrast that with company BA, Rylan. Starting way down in the negative in 2020, EPS was negative RM.3, then negative 0.05 in 2021, only turning positive in 2022 at RM.02. So yes, they have turned a profit, but that number is teeny, only 8.8%. That's not recovery. That's survival. They're still far from being back on track. And that brings us to the next slide. Valuation and dividends. This is where things get really interesting. On the left, the company age PE ratio between 2.4 to 2.7 times. Extremely low. That means the market is pricing it as if it's not worth much. But wait, its EPS is growing. Dividends are rising from 5 to 7, and it's being paid out every year. So why is it so cheap? Maybe the market doubts its long-term results. Maybe investors think it's too small or too risky. But here's the thing. Low valuation and consistent dividends equals classical value opportunity. For someone who wants income, this looks like a smart bet. Now flip to the right. The company BA PE ratio hit as high as 65 times in 2022. This is crazy. That means investors were willing to pay 65 times its earnings, even though it had almost no earning. Why? Because they believed in the turnaround. They sold out restructuring, asset optimization, and a new management team, and they got excited. But here's the catch. No dividends paid from 2020 to 2022. All the money went in to fix the balance sheet. So, for income-focused investors, not attractive. And with such a high valuation, the risk is huge. Return depend entirely on stock price going up. If the recovery stalls, the stock could crash. So what's the big picture? Two companies, same industry, same storm. One, the company edge, built resilience, its earning profits, paid dividends, stayed grounded. Market and pressed it, but maybe that's because it's undervalued. The other, the company BA, take a gamble, restructured, recovered, and now trade like a speculative place. High hopes, zero PRs, and a lot of uncertainty. So which one would you invest in? It depends on your style. If you want steady income and safely, go with the company edge. If you chase big gain and believe in a comeback, maybe the company BA. But one thing clear, financial success isn't just about making money. It's about how you make it and what you do with it. Next, Lu Quan will introduce the investment suggestion of the two companies. Thank you.
Hi everyone, my name is Wang Luquan. My student number is P166977, and I do the conclusion part of our team project. So let's wrap up our analysis of Bumi Armada and the Biscuits Petroleum with the key points and the investment tips. First, let's go through the 5 most important findings. First, look at the H stock alone. H is better all around. Its average monthly profit is about 1.9%, higher than Bumi Armada's, and H is less risky. Its price only moves up and down around 16% a month, while BIS moves nearly 20%. So H gives more profit with less risk. Second, mixing two stocks works well. The combined risk is lower. Even though they are both in oil and gas, their business don't go up and down at the same time. So putting them together cuts down the risk. Third, both stocks react more to market changes than most. Their beta are both over 1. Base is about 1.9, but the edge is around 1.8. That means when the market changes, these stocks move more rapidly. So they are not for people whose risk dislike. Fourth, their money strategies are totally different. Edge keeps making more money per share. The price is cheap compared to the earnings, and it pays more profit every year. B lost money until 2022. The price is way higher relative to earnings, and it didn't pay any profit those years. Clearly, Edge is in better financial shape. And the fifth, the best way to invest your money is about 73% to Edge and 27% to B. This combination has the lowest possible risk while getting returns. Hibiscus should be the main part of your portfolio if you invest both. And now, let's talk about the investor suitable for each stock. For Edge, we really recommended it because it's a medium risk stock, great for holding for a few years or more. It focuses on mature oil fields, so it avoids the big risks of looking for new oil. It has steady cash flow, even when their industry is unstable. Their earnings and profits keep going up, and it's undervalued right now. It's perfect for people who want to invest in energy but don't want too much risk. Those who want steady dividend money or anyone looking for cheap, good stock, you can use it as a core part of your portfolio, mixed with a little boni. And for the boni Armada, investors should be very careful. It's high risk, only good for short-term trades. It can drop off to 60% in months. The profit isn't worth the high risk, and the business depends too much on big offshore projects that easily get hit by oil price changes or policy shifts. Only invest here if you can handle big loss. You are chasing short-term, high risk, high rewards plays, or you really know the offshore oil and the gas industry with well. If you are a careful investor or need steady income, stay away. So to sum up, Hibiscus is a reliable choice. Good basics, steady returns, and cheap. And the Bumi Armada is a risk bet, only for risk-like investors who can take big price swings. So that's all for our summary. Thank you all for listening. Thank you.